So we've seen strong performance from private markets. You can see here over the last 3 years, private equity in this case, has outperformed quite significantly. From your point of view, what are some of the factors contributing to this strong fund performance? But Chris, can you kick us off?
Sure. I come at the question from the micro standpoint. What's going on the ground that would allow outperformance? And I've come up with 4 factors. The first is favorable selection bias versus the market. If you buy the S&P 500, you have to buy everything in the S&P 500. At a private equity firm, we get to pick and choose what sectors we want to play in, what companies we want to play in. And I think that versus the marketplace allows us to outperform. Secondly, we choose our entry and exit point. We don't have to sell a company when there's a down market. Mr. Market prices every single day. We get to choose our timing, and I think that helps quite a bit, particularly playing through cycles. The S&P 500 is not as leveraged as the average private equity investment. That's not true for our firm. 2/3 of our companies are completely unleveraged. We're more focused on growth and investment, but for the industry, the leverage in a good market will enhance returns. And finally, certainly over the past 10 years, the industry has really honed its skills from an operating standpoint. From our perspective, again, micro on the ground, we are go-to-market specialists. We're looking for that adolescent company that has an awesome market opportunity and probably just doesn't know how to scale its go-to-market activities. And we help those companies achieve those goals and help the industry achieve better returns overall.
Griff, can I ask you to weigh in on this? Maybe we can look forward to the next slide. What do you think are some of the drivers behind this outperformance? And as you know, we talked about being on the cusp of a downturn. I'm not sure when that's going to come, but will this strong performance, this outperformance, see us through that too?
Yeah, well, maybe I'll take the question, turn it on its side a little bit, and talk about this from a macro perspective, and relate to other LPs out there. I think as you're looking at some of the data that we have here in the presentation, my one question is, what's not to love about private markets? There's an amazing stat here that our data department has come up with, which is in 19 of the last 20 years, private equity and private credit funds have outperformed a relevant public market index. That's terrific consistency. So consistency is my first point. And you do see on this slide how that translates into 15-year asset class performance, typically over 300 basis points above public market indices rather. And that's really what our LPs are looking for. The second thing, not reflected in the slides, but I think is a very important aspect of the asset class that a lot of LPs focus on, that would be upside. I think all LPs would consider themselves terrific at picking top quartile managers. If you don't think that you're doing as well with that today, we'd love to talk to you. We've got data, technology, and some services that might be able to help. But if you do consistently pick in the top quartile, you're going to double your outperformance above the public markets. So it's just incredible opportunity for upside in this asset class. The spread of returns is a terrific feature. The third thing that I want to talk about, and if we look at this slide, which we call at Hamlet's Lane our periodic table of returns, there's a lot going on here. Search for the pattern that makes sense to you. But let's look at the very bottom, which is vintage year by vintage year. Where are there years where you've lost money within a single strategy? There's only 2 years here with the dark black box around them, 2009, 2010 in natural resources investments. There is very low risk of loss in this industry. There's a number of ways to look at that. One of them would be vintage year returns like this, where you barely ever see vintage year returns below 0%. Another way would be you spoke about a downturn and the risk of drawdown in valuations. A lot of people might look at the asset class and say, well, are your returns just smoothed? And the reason you don't fall as much as public markets, isn't that just because of the inherent smoothness and inaccuracy of valuations? I think a lot of LPs might look at that as a feature, not a bug. I think it's really helpful to be able to ride out the downturn and not see your valuations drop as much as your public assets. One more stat I'll leave you with, on a buyout basis, buyout being about 65, 70% of the asset class today, only 14% of buyout funds historically have lost value. These funds are inherently diversified and it's just very hard to lose money. 71% of them outperform the MSCI World Index. So just incredible stats here. We've got a lot more, but just it's been a very consistent asset class outperforming the public alternative.
So in no small part due to that outperformance, in 20 years, the private markets have grown from $500 billion to $5.7 trillion. You can see from the slide here what that roughly equates to, about 6.1% of global GDP, the same size as Japan. Will this upward trend of more and more AUM continue? And what are we seeing as some of the unique strategies GPs are deploying in order to hit these record fundraising numbers? Rick?
Yeah, so I think there's 2 points that I'll make on this topic. One, addressing what Griff and Chris just talked about in regards to performance. We're seeing records amount of returns coming back to investors, and those dollars are getting recycled into newer and larger funds, and allocation sizes are going up. So that's driving AUM growth. Number one. Number two, we are seeing firms becoming much more technologically sophisticated from an investor relations perspective, leveraging platforms like DealCloud, leveraging some of the follow-on products that we have, one called Dispatch that allows for high-frequency communication with investors, announcing new funds, new deals, results, news. A combination of those two things, I think, is not the sole factor, but certainly a contributing factor to the growth in AUM.
Griff, do you want to weigh in on this one?
Yeah, I think there's no doubt about it. The industry is growing, and we can see that trend continuing. Hamilton Lane is seeing more and more managers come to market fundraising every year, and we're going to talk about some follow-on effects of that throughout the afternoon here. One thing that's not shown in these charts, by the way, that we're going to show you today, and it's hard to measure but has an impact, is the shadow capital that we think about, the growth in co-investing, the growth in secondary transactions. Going back to the slide on the point about Japan and sort of this relative sizing of the private markets, we put the size of the private markets as 6.7% of all global financial markets. And that's the comparison of Japan to global GDP. So thinking about this $5.5 trillion we have today in the private markets, if we just sustain that 6.7% allocation, our estimates would be that in 10 years, the AUM in private markets is doubling to 10.5 trillion. I think there's reason to believe we could double our market share, which could mean that the AUM for private markets is somewhere close to 21 trillion in a decade. So, you look at the performance figures that we just talked about, look no further than that for reasons why people are allocating more and more capital to this industry, which is growing the overall AUM.
Chris, maybe you can give us the GP perspective, having recently been on the fundraising trail. Yeah?
Sure. Well, speaking to this point about growth in AUM, I'll give a micro example that I think will help illuminate this. Recently, we purchased a half interest in a software business for $60 million. That software business had been financed by angel investors. The angel investors are not captured on any of these charts, so it wasn't AUM in anyone's recording. So immediately you're at 60 million of AUM. 3.5 years later, we sold the business for $600 million. And a private equity firm stepped up to buy that from us. They used some leverage, but they wrote a check for $400 million to do the deal. So in a matter of 5 years, we've gone from zero to $600 million of AUM that's been created. So there's 2 points here. One is the participation of private capital markets in the growth economy and how that's getting deeper and deeper and longer, and a company that maybe would have gone public is now staying private. And the other is innovation and growth. It is driving value creation, and private equity is very good at finding ways to participate in value creation.
Picking up on Rick's point about LPs increasing their allocation to private markets, I wondered, Griff, if you could give us your opinion how are LPs balancing wanting to deploy more and more into these asset classes with wanting their GPs to stay in their sweet spot? You know, they like this manager at a 3 billion size, they don't want them to become 10 billion. So how is that? How are they weighing that up?
Yep. Yeah, I think that's an important consideration that LPs have. You know, I think that let's talk about the last cycle. Some of the GPs we saw coming back with much, much larger funds, and you know, funds that, frankly, if you look at their most recent deal pace, they would have a hard time putting to work in the number of years that they were saying. They would really have to step up the size of the deal or the pace at which they were investing. Today, we recognize those as red flags and flashing red lights. You know, something to be warned about when it means you know, the down cycle might be coming. But I think today is a little bit different than that. You are seeing some GPs come back with some larger fund size. Sometimes that's just a natural evolution of the general partner. They're building out their teams. They're naturally evolving their franchise to be able to handle that. So if they have the right infrastructure, the right culture, and the right team to handle the bigger deal size, you know, that's a-okay by, you know, for a lot of LPs. But that's really why you have to do your diligence and dig in with, you know, can they handle the step up that they're going for? We're also seeing GPs take a different approach this time around, which is diversifying their franchise, coming out with a credit strategy if they were traditionally a buyout manager. In the venture capital space, maybe having a follow-on fund that's more growth oriented. Again, I think it's about doing your diligence operationally on these managers. Can they support these different franchises? Have they really built out the personnel to handle it? Some LPs might look at this as a good way to manage their relationships. They really trust the GP, the culture, the franchise there. And if they're able to get multiple strategies out of them, that puts the choice in the LP's hand about how they want to diversify their investments and establish certain GP relationships to really prioritize.
Yeah, this is Rick. We're seeing that too from our perspective. We're seeing the smaller middle market funds raising larger funds and coming up market and doing bigger deals. And just the same, we're seeing the larger, more global buyout funds, both in the US and in Europe, come down market and creating smaller funds as almost a feeder fund for the larger funds. So we're seeing that complexity, we're seeing that level of diversity, not just here in the US, but globally.
Having just raised capital this summer, we were scrutinized by firms like Griff's and came away successful. And it's interesting, we had this conversation very directly because we, in the last three funds, we've gone from $1 billion to $1.5 billion to $2.5 billion. And the obvious question is, are you doing something different? How are you going to handle the money? And what we pointed at was, number one, we're still playing in the same relatively small market. We're basically in the $50 to $500 million enterprise value zone for the companies that we're acquiring. And that's a pretty small part of the marketplace, the lower end of the middle market. Number two, our team did grow. And we have more partners today, almost double the number of partners we had coming into that previous cycle. But it really is evolutionary change. We used to be a firm that did 4 to 6 deals a year, but now with a much bigger staff, almost double compared to that $1 billion fund, we do 8 to 10 deals a year. You do the math, it roughly is the same number of companies. And ultimately, we had put $2 billion to work in the previous 24 months. So raising $2.5 billion was not a stretch for our firm. But all the statistics are the same when people are measuring them.
So an increase in AUM is, of course, leading to an increase in dry powder. We can see from this chart on the screen here, the amount of unfunded capital in the market right now. How should funds measure and tackle this problem? How should we interpret these numbers? And have you seen any interesting strategies that dealmakers can bring into 2020? Griff, can you start us off?
Yeah, I think this chart here is notorious at my firm. Let me just start by saying our point of view is this matters not at all. This does not matter. Unfunded capital is a red herring. I think there's every reason to believe that this is going to continue to increase, and it's just a natural evolution of the asset class. We just talked about all the reasons that AUM was going to be increasing. Unfunded is simply part of the AUM number. GPs have, maybe around 5 years to put capital to work. They're going to have dry powder on the sidelines. I think there's a stat that we prefer to look at that's not here, which would be how long under the current deal-making pace would it take to put this capital to work? Right now, that number, as we calculated, is 2.7 years. That hovers right around our average historic rate. So there is nothing here that's signaling that we need to be worried or watching out for something. But people love to talk about it, so we always put the chart together, even though we view it as pretty much meaningless.
So as long as that number stays stable, we're in a sustainable place.
I think so. I think that's something to watch out for. The other thing that we've seen, and we've talked about it with diversifying franchises, and we've talked about the growth and some of these other private market strategies outside of the traditional venture capital and buyout. You're seeing it in this chart. The industry is evolving. There's more options for LPs. There's more strategies that GPs are pursuing. So some of the AUM and the unfunded growth is simply the growth and maturation of the industry itself and other strategies.
Chris, as someone putting this capital to work, how do you view this?
For us, it's innovation. The past 20 years have been so amazing in terms of technologies filtering through the entire economy and creating not just technological changes, but changes how people shop and the consumer economy, or how people look at x-rays, and the list goes on and on. What we're seeing is the private equity industry embracing this change and finding ways to own the value creation that's growing. And the example that I gave, obviously, it can be dramatic in terms of the value creation growth. So in our little part of the world, I would say that the innovation economy has created an enormous opportunity, and we're capitalizing on it.
Private company growth is significantly outpacing public companies. You can see from the slide here, 52% growth in the number of private companies. How is this impacting competition amongst the private equity firms and the investment banks and advisory firms that are working in this space? And what are some of the factors contributing to this trend, Chris?
Well, we start with this notion that I was just touching on, that there are so many more companies. I'm not sure how that impacts competition, other than to say that we see more deals now, more opportunities than we did 10 years ago. But there's more capital available as well. The other phenomenon is that the private equity industry and the growth capital business can take a company now from cradle to grave. You've got the venture players who start the company, the growth players who take it through its investment phase, the growth buyout players who give those early shareholders liquidity, and the buyout marketplace to back cleanup and ultimately deal with more mature companies. It's harder to be a public company. I think it's less desirable to be a public company, and the private capital markets are using the opportunity here for both primary investment and shareholder liquidity to deploy in growing industries.
Rick, what are you seeing on this from the competition side?
Yeah, so maybe taking the entrepreneur CEO view, and given the discussion we just had on records amounts of AUM, one would think in my position you would have more choices or options. When I started 10 years ago in this space, there were 2,000 GPs. I think today there's something like 6,000 or 7,000. So yeah, naturally there are more choices and more options. So maybe flipping it now on its head, if I'm a GP, I need to be thinking about some level of sophistication and technology that gives me the best opportunity to find the companies that are in my wheelhouse, in my sweet spot, and putting me in a position to proactively have them called on when they may be ripe for funding. So what we're seeing now, along with the technology, along with software, is the culmination of and the coming together of software and data. And so much so that we've actually built out specialized products here. We have a product called Data Cortex that does exactly that. It brings outside data with some of our partners like Preqin and PitchBook and Sutton Play Strategies into the Deal Cloud platform, enriching your proprietary data with outside data, such that you are in a position to react accordingly when there are certain key elements in a company's life cycle where they may be ready for funding, initial funding, or the next level of funding.
For those that are listening, the panelists will be taking questions, so please send your questions in as we're talking. We'll get to those shortly. Let's move on to the next slide. Here, we've got this idea that investors have been scraping the bottom of the barrel a little bit with secondaries and sponsor-to-sponsor deals at an all-time high. Is this putting pressure on deal teams, and how is it affecting intermediaries and bankers? Rick?
Yeah, I don't know if I'd classify it as scraping the bottom of the barrel. I think I was thinking about this yesterday. I would classify it as kind of natural evolution. We're seeing funds that are much more sophisticated and highly focused, not only in specific verticals like healthcare or biotech or fintech, but also stage of company. So you may have a venture fund that invests at an early stage and grows that company up and gets it ready for its next level of funding for growth equity for a fund like Chris's or something of that size. That to me is a natural progression in the space. And to Chris's point earlier, company, it's not such an attractive offer. The IPO path isn't such an attractive offer anymore. And there are larger, again, global buyout funds that can provide the liquidity to the earlier stage funds and also fund the companies for their next level of growth before maybe even a strategic acquisition. So don't know that I would classify it as that necessarily, but certainly a big part of the ecosystem.
Chris, is turning to you on this. Maybe you can answer this a little bit from the valuation perspective as well. This sort of difference in price, often, it's thought of that strategic buyers can pay up because of some of the synergies that they're expecting to get versus financial investors. So what are you seeing on that side?
So first, I'll offer some stats. Since I'm the guy with the micro point of view, I can only give you the T sample of our last 24 months. And we've sold 10 companies for $6 billion. Strategics purchased 4 of those companies, representing about 50% of the enterprise value sold. PE-backed strategics purchased 2 more, and that represented 20% of the enterprise value sold. And 4 companies were sold to straight out to PE firms, and that represented the last 30%. So interestingly, we've been following this over the long term. And our long-term history as a firm is that 85% of our profits have been generated in sales to strategic buyers. So if you include the PE-backed strategics, we're roughly 10 points lower right now over the past 24 months. And if you don't include the PE-backed strategics, then there's some material change. I'd say this makes sense because of the evolution of the business. Some of the sales are to firms that didn't exist 10 years ago and couldn't play at a scale, at the dollars, or with the kind of expertise that the strategics played. We still try to find businesses that have a strategic exit because they have the lowest cost of capital. But I would say that on the margin, we are seeing a maturation of the business and more strategic-like behavior from private equity firms. But it's marginal. It's not a huge difference.
Rick, maybe you could answer this follow-up. Obviously, we've been talking about the huge amounts of dry powder in private equity system or private markets in general. So those players obviously are looking to deploy capital. Are you still seeing a lot of hunger from strategics to pick up assets too? Are they also in buying mode?
Yeah, I think that they are. To Chris's point, the larger PE funds are at a level now where they're competing with the strategics from a valuation perspective. We're seeing that as well. Even specifically I think the PE-backed strategics even more so. So that I don't know that that's a trend that is an anomaly. I think it's growing, and I see it maintaining into the future.
And if I can add a piece to that, I think that there's a connotation that a sponsor-to-sponsor deal somehow is inferior or offers less opportunity for growth. Our median growth rate in our portfolio for our companies is 26% top-line organic growth. And obviously our bigger sales generally occur for companies that have even faster growth rates. How terrible is it for a large private equity firm to buy a company growing at 40%? And what is the appropriate price to pay for that type of growth? These are some very high quality companies. And again, back to this notion that innovation is creating huge value. Value doesn't stop at $600 million. Companies can grow to be much more highly valued. And I don't think the old connotation applies given the businesses we're now talking about that have different value creation opportunities.
Yeah, and just one more point on the topic. I think the banks, the investment banks, are getting much more sophisticated as it relates to sponsor coverage and bringing their connections and contacts into the deal making process. And we're seeing them leverage our technology to do that, being able to connect the ecosystem through technology, through DealCloud, not only the companies, but the contacts, the bankers, the law firms, the accounting firms, all in this, what we're calling the deal-making ecosystem, is becoming much more succinct, given what we're able to do from a tech perspective.
Speaking of technology, that brings us nicely onto the next slide. One moment. So this is showing how much firms are spending on technology infrastructure and data annually. What are the risks of not getting your technology house in order in 2020, and what are the implications for 2021 and beyond? We can see here there's 16% who are right at the bottom of this chart. Rick.
Yeah, I guess not surprised to see this. We talk to several thousand firms a year. And, what we specialize is really in the front office technology, which is you would think it would be a place for a lot of these firms to invest. A lot of them are waking up and recognizing that tech can have a big impact on their results and their ability to put capital to work. As such, we've seen a very fast growth rate here, not only on the private market side, but on the banking side as well, because these are really interconnected. So yeah, not surprised to see this. And I think, like I said, firms are waking up, and the tech is going to get better over time as we start to introduce new products, artificial intelligence, alerting, notifications, which will put the firms that make this investment at even a better spot, have a better advantage in the market.
Griff, what are your thoughts on this?
Yeah, I mean, when I look at the bottom of this chart, I really question the decision making of some of these firms. I think it really speaks to me to them not investing in the future of their franchise, under investing in their long-term potential. Our perspective at Hamilton Lane is that data, technology, they're fundamentally must-haves now. It's no longer a nice-to-have. A lot of that science, data science that's been built up in the public markets for so long, it is coming rapidly to our asset class. And the use of data and technology is really integral to the decision-making for a lot of top firms that we work with. At Hamilton Lane in particular, we've really integrated it through DealCloud, through Cobalt, into our investment workflow, into our investment decision-making, and how we think about portfolio construction and forecasting and really everything that we're doing. So over the coming years, our perspective is there's going to be winners in this asset class and there's going to be losers. And one of the reasons that you might win as a GP, it's that you're using data to source, evaluate, and manage your deals. On the LP side, you're using data and technology to find those best managers, think proactively about portfolio construction and about managing your portfolio. And we really truly believe that's going to reflect itself in the ultimate performance. Then you've got the other side, and we would fully expect some losers in this asset class to emerge that underinvested and had a tougher time managing their their companies, monitoring them, raising their next fund through lack of data, through lack of technology. On the LP side, if you're still passive with the way that you're managing your portfolio, much harder to outperform. And comparing yourself to other LPs is becoming, a much more common thing to do in this asset class. So, a lot of your peers, I'd be looking around, a lot of your peers are probably investing here, and we would urge you to do the same. From our perspective, it's about adding transparency to this asset class, integrating analytics into the decision-making process. And that's really a big part of our aim at Hamilton Lane and what we try to help our clients with.
So if I could add a managing partner's perspective on this, we've had a combination of homegrown technology as well as outsourced technology since the firm began. We actually used something called Sales Logics, back when there was Sales Logics, if anyone remembers that name. Then went to Salesforce, didn't have a great experience, and that's when we went to Deal Cloud, and our relationship with the company began. This was before we ended up purchasing Deal Cloud in one of our portfolio businesses because it worked so well. And I would say that we're now seeing complication in the business rising to a level that if we want to compete, we really have to outsource. There's no way we can have the development staff internally. But I think even more importantly, the productivity tools that are coming down the road with AI and machine learning are really going to change everyone's business. We're investing in that in some of our companies, including Deal Cloud, but we're thinking about it in terms of what will an analyst, an associate, a VP's life look like? And if it's not a partner for that matter, and if it's not machine assisted in 10 years, will anyone be able to keep up? And I think we're going to see a lot of changes. So this is just an accelerating trend. It could be a topic in and of itself that we could cover for a long time, but I would highlight it as something that I think from a competitive standpoint, critically important.
The concept of technology infrastructure can be quite daunting. If you're a deal partner, you just want to get out there and do deals rather than necessarily think about these things. If you're somebody who's maybe listening in that red zone at the bottom there, where can you get started? What should you be prioritizing if you're just starting to build this out at your firm, Rick?
Yeah, that's a good question. The landscape for options has changed dramatically over the last 10 years. I think when I was back at eye level and spinning that thing up, there were 5 or 6 companies, maybe, that were technology vendors in this particular space. If you look today, there's probably, 60 or 70 of them. So there are choices out there. There are suite solutions that try to cover the gamut, front office to back office. We've seen them be, I think, less effective than what one might think. And then there are point solutions to solve for the 3 swim lanes that we call it in the kind of tech stack: front office, middle office, and back office. So I think, fundamentally you have to make a decision of what strategy you want to do. There's different firms with different sizes and different levels of complexity. There are consultants in the space that certainly can help and provide options. But I think becoming knowledgeable in the space and some of the options and technologies, without being biased, obviously, but it's important to know what's available and know what's out there.
So Chris mentioned outsourcing, and I wanted to touch on that a little bit. Griff, you mentioned from the LP side, I think we've got some LPs listening. Some of these investors, they're very small teams and they've got a lot to do. So when it comes to looking for outsourcing partners, what are some ways to ascertain whether that's going to be a good partnership? How do you find someone that kind of jives with what you're trying to do?
Yeah, no, that's a great question. I think I've got 2 points, one more philosophical, one very much more practical. I think, from a high level, do your homework first, and really, what I would say is come up with what we call your data strategy. you don't want to be investing in the capture of data and technologies just for the sake of those things. You really have to have a plan. So before you go talk to anybody, figure out how you really want to integrate data into your decision-making process, which is then going to tell you what data you need to be capturing and organizing and how you want to be leveraging it. And so now you have your needs. You've done that homework. Now it's time to talk to the partners. And from a very practical perspective, Rick talked about the growth in competition. That is absolutely true. There's a lot more options out there. That's a great thing for a picky buyer. But the thing that I would really focus on is it's time to find a partner in the tech space. That's really worked for us at Hamilton Lane, identifying groups like a DealCloud, like a Cobalt, where we would have a voice at the table. We felt valued as a customer. We saw what they were doing. They had ambitious plans for building, and we knew we could be part of that growth story. And that over the long term, they're not just meeting our needs today, but our needs for the future. And so I think that aspect of building a partnership with your vendor on the technology space has been really important to us.
Chris, maybe you could talk a little bit more about your experience with vendors and how you go about finding the right fit for you.
The hard part is keeping track and keeping up with the proliferation of people providing technology and data in the marketplace. It has changed so dramatically. I'm just echoing what Rick said. And I can only encourage other GPs and fund managers to devote resources to making sure that you know what your options are, because there are so many and they are very different. Another point that I'll make is, particularly at the smaller fund sizes, we tend to think of ourselves as a cottage industry. It's a bunch of people doing a bunch of deals. And why would we accept an answer to a competitive and strategic question like what's your data strategy, what's your technology strategy from a portfolio company equal to the one that we would give ourselves? We would give ourselves a failing grade and replace ourselves. And we would tell them to spend some more money and go out and get a better answer. So we need to treat ourselves like a business as well. The industry is maturing. It's going to become more competitive. We need to start thinking of it like business people and not like deal doers.
Love that. GP needs to treat itself like its portfolio companies. Do have a question in from the audience. Why do you think private equity is able to outbid strategic buyers?
I see examples all the time where private equity outbids. Let's acknowledge, what does the strategic have as an advantage? Generally cost of capital, right? They can borrow money incredibly cheaply, more inexpensively than a private equity firm, although debt doesn't cost that much. Interestingly, when we run our numbers on a deal, changing the interest rate and the interest factor doesn't produce a tremendously different return case. So how important is cost of capital? It's important, but it's just a consideration. I think there are lots of cases where the value creation going forward for the company is something that one set of eyes, one set of people can be quite strategic on and have an angle on that a strategic might not have, and or be able to actually get the value out of the company from an operating basis that strategics are not well known for operating these businesses incredibly well. Everyone jokes that you sell to a strategic and then the company dies. It's not just the outbidding, it's what's going to happen after the fact, and I think there's plenty of very good reasons why. When we buy a business, many times someone financed the business. 75% of our capital goes to companies, goes to the shareholders, not into the company themselves. So we're buying from shareholders. They took it to a certain level. We see a lot of meat on the bone, and that doesn't mean that there's nothing left when you buy it for $600 million versus buying it for $120 million.
We mentioned a little bit at the beginning about being quite late in the cycle. Obviously, nobody knows when the downturn is going to come, but question here, are we at peak private company valuations, or can it continue to go up with such an active private market? Griff, do you want to weigh in?
We're certainly higher than we've ever been. Is it at peak? I don't know. And I would think that there are reasons that you could absolutely go higher from here. I think, when we look at performance historically across deals by purchase price, it's no doubt about it. from a macro perspective, higher prices lead to lower returns. It's pretty basic, right? At a micro perspective, that's not always the case. So there's plenty of good companies out there worth paying up for that have strong growth stories and would lead to ultimate returns. We've seen that historically in the data. So a lower purchase price doesn't inherently mean better returns on a micro. So it's probably a non-answer for you, but because I don't have the crystal ball, but certainly, it's something we're wary of.
It's buying smarter. Really.
Buying smarter, perhaps.
Right. Well, I think we're going to finish it up soon, but just to ask one last question. Again, it's a bit of crystal ball gazing. Or if you could only invest in one strategy or industry in 2020, what would it be and why? This is maybe back to your periodic table matrix that we saw earlier. Chris, I'm going to pick on you first.
That's a tough one. Are we talking from the LP's perspective? Can we talk from the LP's perspective? In which case, then I'd say focus on firms that are looking at fundamental growth. Because bottom line, when we're talking about valuation levels and where we go from here, it seems like we've moved the multiples up. What's left is fundamental growth. So find firms that extract fundamental growth from the marketplace, and I think that's the place you'll do best.
Rick?
Fundamental growth organically or inorganically or both?
Inorganic strategies work, but I would focus on organic strategies as sort of a good place to be.
I would agree.
Yeah, I think we would consult with our LP clients to not change up too much just because you think that a downturn is coming. I think historically, what were some mistakes people made? It was not keeping up consistent investment pacing, trying to time the market, so to speak. Incredibly hard to do in any asset class, but with private equity, you're really steering an aircraft carrier. So trying to turn off the spigot and turn it back on right at the right moment really did not work for the LPs that we saw attempt that last time. So, really, I think it's stick to the basics of portfolio construction, and I wouldn't recommend trying to pick that one winning strategy. It's build the portfolio that meets your needs and keep that consistent investment pace together so that you have an opportunity to invest opportunistically should things turn.
All right, Chris, Griff, and Rick, thank you so much for joining today, and thank you to everybody who dialed in.